Hi, my name is Kishore Subramanian, founder and CEO of Shree Consultants, and today I am going to demystify term plan for you. There are multiple doubts which people have when it comes to term plan. Let's begin with what's a term plan. As the name suggests, it's a plan for a particular term, and in the insurance parlance, it is a product that's taken as a pure risk cover. What does a pure risk cover mean? A pure risk cover means you take a plan, you pay a premium, you are covered for a sum insured, and if unfortunately an eventuality happens with you, then your nominee, your family, your spouse, or children get that sum insured. But if nothing happens to you, generally the money is to be counted as expense or spent. So the moment I say to a customer that this is not an investment, but this is an expense, the doubts start. So what are the doubts? Number one, is it even intelligent to pay money and not get it back, assuming you're going to be alive? The answer is yes. And you may ask me why. The simple reason is, if you pay money as expense and protect the peace of mind that you get and the safety that you get in terms of your money being spent to protect the family's interest in case of a loss of life or eventuality is very important. Let me give you a quick example with a calculation. A 25 to 30-year-old man wants to insure his family for 1 crore, as in himself and the beneficiary being the family. All that he needs to spend is anywhere between 8 to 12,000 rupees. Now tell me, a car that's about 4 to 5 lakh rupees costs somewhere between 12 to 15,000 rupees as insurance, while a life that's worth 1 crore is costing less than that. Is it not value for money? The answer is a sure yes. Number two, when it is an expense, should I do it now or should I do it later? That's the logical follow-up question. Remember, you should do it now, immediately, today, instantly. The reason is very, very simple. The younger you are, the fitter you are, the lower is the premium. And you or I would always like to take a product where the premium or the outflow is the lowest. So lock your premium for the longest tenure at the lowest price. The third point, many people come back to me and say, oh, you know that I've got a property, I've got assets, I've got inheritance. Why do I even need that? Remember, term policy is a substitute for your income. If you are a money-making machine through salary, through business income, or any other source, that income substitution is extremely important if you have a dependent. The dependent could be a mother, father, son, or a spouse. And it's very important to protect that. So don't assume I have assets, I don't need term plan. Absolutely wrong. The fourth important point, there are plans available where there is return of premium. There are plans available till 70, 60, 80, 90, 100. Which one should I take? The golden rule is, think, how long do you need the cover? Is it till 60? Is it till 70? Is it till 80? Is it till 100? Take it right away. 2. Return of premium is expensive. As in, if a non-return of premium is 100 bucks, a return of premium would be typically 140 rupees. That's 40% more. Now, if you pay 40% more, you will get your money back. But if you pay that 40% into an SIP or another investment, you will earn much more. So the lowest premium with the longest tenure without return of premium is the wisest. Now, added to this point, many people say, okay, let me take for 1 crore, that's good enough. Remember one thing very important. Whatever is your salary, multiply that by 20, add the value of your liabilities and cover yourself. And if you're getting more, cover yourself. Remember, protection is the first part of any solid portfolio building. Why? Because if you don't have protection and you have started an SIP or an investment or a real estate, all of those to continue is dependent on one single factor, that's you being alive. And remember, that's the uncertainty. So when it comes to term plan, the earliest, the longest, the cheapest, no return of premium, and You will be wondering how many people worry about claim ratio, claim settlement ratio, cost of premium. Remember one thing. Insurance as a product is a socially protected product. What do I mean by that? No company in India has ever gone bankrupt, which is an insurance company, because it's regulated by the Insurance Regulatory Development Authority, the IRDA, and it's protected. Which means even if an organization goes bankrupt, the government will interfere and take it over through another company, which effectively means your policy is damn guaranteed. No other way. So you don't have to worry about the claim ratios and stuff if you do three things. One, don't hide any material facts. Your health, your age, your size, your height, your weight, nothing. Don't hide anything. Point number two, undergo the medical test that they prescribe in the truest sense of it. Number three, any known diseases that you contract after you've taken the policy, still intimate the company. If you do these three things, pay your renewals on time, track the policy, take adequate sum insured, the big tick is that you're going to get your claim if something goes wrong. We pray and hope nothing happens to you, but don't leave life to chance and not take a term plan. I hope this information was useful. To know more about term plans, investments, insurances, and other financial products, follow us and hit the subscribe button.